5 reasons why property will cool in 2023. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee. I thought we'd have a look at this report from Dr. Shane Oliver of AMP. 5 reasons to expect a cooling in the Australian property market and falling prices in 2023, everyone. Falling prices in Australian housing. Is that even possible? Has he asked the government if he's allowed to even say this? Is falling house prices, has that been declared hate speech yet in Australia? I wonder if YouTube will still let me put these videos up. If only lucky YouTube isn't quite controlled by the Australian government yet. So here are the key points. After a 22% rise in Australian home prices this year, they're expected to slow to 5% in 2022, and with prices likely to fall 5 to 10% in 2023. Okay, so we're still not going to be anywhere near what we were complaining about in 2019, everyone. I don't even want to know what property is going to be in 2029. That's going to be a scary one. The main drivers behind the slowdown are worsening affordability, rising supply, rising rates, macroprudential tightening, and a rotation in spending away from housing. The main risk on the downside are another big COVID setback or faster rate hikes, and the main risk on the upside would be a fast return to pre-COVID immigration. Yeah, I think we'll there's going to be betting the farm on that one. What do you reckon? So, fastest home price gain since '89. Australian home prices have boomed this year. They're up 22.2% over the 12 months to November, according to CoLogic, with Hobart up 28%, Sydney 26%, Brisbane 25%, Canberra 25%, and regional prices 25%, leading the charge. This is the fastest annual increase since '89. Average capital city prices are now up 18% compared to their previous record high in 2017. The surge has been driven by a combination of record low mortgage rates, multiple government home buyer incentives, government income support measures, pent-up demand from the lockdowns, activity associated with a desire to escape from the city, a switch in spending from services to goods, including housing, and an element of FOMO, fear of missing out. But momentum is continuing to slow. However, while the surge in prices has been big, the puff is coming out of the property market. Average dwelling price growth peaked at 2.8% month-on-month in March and has slowed to 1.3% in November. Price growth in Sydney has slowed to 0.9% and Melbourne to 0.6%. Okay, we can see it here. Oh boy, I mean, the average capital city home prices, the first rate hike, macroprudential tightening. Yeah, there we go. 8 capital city average there in red. How can we handle this fall in growth? Consistent with this loss of price growth momentum, while auction clearance rates are still very strong, they've fallen around 10 to 15 percentage points from their October highs in Sydney and Melbourne. There you go. Of course, the slowing in national average price growth masks a divergence with previous laggard cities. Oh, laggard! Of Brisbane and Adelaide, yeah, that's pretty accurate, seeing their strongest monthly gains of 2.9% and 2.5% in November since 2003 and 1993, respectively. The average regional price rose another 2.2% in November. Now, I've had all the family members explain this to me, going, back in the day, Sydney and Melbourne property would fall, and then they'd all come to Brisbane. That's what happened. So, 5 reasons to expect a cooling in the property market. At a national average level, there are 5 reasons to expect a further slowing in the average home price growth next year, followed by a peak in prices sometime in the second half of next year and falling prices in 2023. So, worsening affordability is constraining most buyers. That's the first reason. Affordability has long been an issue in the Australian property market. The next chart shows real Australian home prices, average property prices after removing increases in consumer price inflation. The index started in 1926 at 100. I'm going to have a coffee shop before I look at this. This one's going to scare me. So against their long-term trend line, the blue line. Okay. So Australian house prices relative to their long-term trend. So the long-term trend is the blue, and here's the real house prices. So it shot up, crashed, back down. It probably went below that. Went up, boom. So we're now 26% above the long-term trend. Sure, it'll be fine, guys. Sure, be fine. Over the last 100 years, real property price growth averaged 3% per annum, which is in line with long-term average real GDP growth, which is a rough proxy for long-term real income growth. Real Australian property prices have gone through 3 major long-term booms, highlighted with the green arrows, and 2 major long-term busts or weak periods of the last century. Okay, so looks like we may be heading towards, and look at that bust. I think we're more likely to get this, boring flat pretty much. So, the current long-term bull market in residential property has seen real prices rise from 23% below their long-term trend in 97 to now being 26% above it. Over this period, wages have increased by 106%, but home prices are up by 317%, which is nearly 3 times more. The property slump from 2017 provided a bit of a breather and saw prices fall back to nearer than their long-term trend. This, along with last year's rate cuts and various first home buyer assistance measures, enabled first home buyer demand to surge. But the rebound in prices over the last year has more than reversed this, with prices up 22% but wages up just 2.2%. While interest rates are still low, the surge in house prices relative to wages has gone hand in hand with the surge in the level of debt relative to incomes. That now means that it takes 8 years to save for a deposit in Sydney and 7 years in Melbourne. I thought it was 16 anyway. Oh, that's the median. This is now squeezing out first home buyers yet again, which has seen their share of new housing finance fall from 25% to 18% since December. And increasingly, existing owners looking to trade up are being squeezed out as well. This is particularly an issue in Sydney and Melbourne, and partly explains their slowing relative to other cities. So the second reason, the supply-demand balance is starting to improve. Rising listings are at last adding to supply in the home buyer market. According to CoreLogic, national auction numbers over the last week exceeded 4,000 for the first time. Supply is on the rise again, reflecting pent-up selling, the end of lockdowns and high prices. This could start to reverse the chronically low level of listings seen over the last 18 months. More fundamentally strong levels of home building along the red line of the next chart over the next 2 years, following the unit building boom since 2015, combined with the absence of immigrants, which has resulted in a slump in underlying housing demand, the blue line in the next chart, have started to see the underlying supply-demand balance come under control, the green line. As such, we may at last be heading into a period of housing oversupply after years of undersupply. This, of course, assumes only a gradual return, there's the kicker, to pre-COVID levels of immigration by 2025. A faster ramp-up could reverse this. And this is why the calls for 4 million new migrants, or 2 million new migrants, 400,000 a year, to address the labor shortage, this is why it's going to impact housing costs, guys. There you go. There's completions, there's underlying demand. Yeah, well. Third, rising interest rates will reduce the amount new borrowers can borrow and hence pay for dwellings. Okay, rising rates. Fixed mortgage rates are already on the rise, with several banks increasing them by 0.5% or more. And the RBA is expected to start rising the cash rate and hence variable mortgage rates from late next year. Rising interest rates are likely to be a big dampener. The collapse in fixed rates to 2% or less played a big role in the recent boom. Fixed mortgages have accounted for 50% or so of new loans recently, so are far more significant than they used to be in impacting new buyer demand, even though there's no impact on existing fixed borrowers until they roll off current terms, which may become an issue next year. Fourth, macroprudential tightening is reducing the amount new borrowers can borrow and pay for homes. So far, APRA has told banks to increase the interest rate serviceability buffer. They apply to borrowing rates in assessing borrowers from 2.5% to 3%, and are now moving to require banks to hold more capital for higher risk loans. The former will reduce the amount borrowers can borrow, and the latter will raise the interest rate on or reduce the supply of higher risk loans. Further tightening measures are possible. So finally, a rotation in consumer spending back towards services as reopening occurs, COVID and the Omicron variant permitting, may reduce housing demand. So the housing price outlook. With national average home prices up 20.9% year to date, they are on track for a 22% rise this year. Prices in Sydney are up 25% year to date, are likely to be up by 26% this year. However, as noted earlier, this marks a sharp loss of momentum since March as a result of worsening affordability, rising supply, rising rates, macroprudential tightening, and some eventual rotation in spending away from housing. We expect a further slowing in home price gains to 5% in 2022, with prices likely to start falling from around September-October next year, resulting in a 5 to 10% decline in prices in 2023. So his concluding comments. Firstly, with Sydney and Melbourne home prices having led the charge over the last decade and suffering from worse affordability, they are likely to come in a bit weaker than average over the next 2 years, whereas laggard cities like Brisbane and Adelaide and possibly Perth and Darwin are likely to be relative outperformers. Regional prices may also continue to benefit from the work-from-home phenomenon and desire for a better lifestyle. Second, the main downside risk to our price forecast would be if a renewed deterioration in COVID due to, say, the Omicron variant or another, result in a more debilitating economic slump, or if a faster pickup in inflation necessitates rapid interest rate hikes next year. The main upside risk would be if immigration is quickly ramped up to above pre-coronavirus levels, resulting in a renewed property supply shortfall. This could result in another year of rising prices in 2023. Finally, we remain of the view that we may be getting closer to the end of the 25-year bull market in property prices. The 30-year decline in mortgage rates is likely over, so this tailwind for property prices that enables people to keep borrowing money to pay more for houses is likely over. Strong home building in recent years, the collapse in immigration over the last 2 years, and only a gradual recovery in immigration ahead could remove the chronic undersupply of property, and the work-from-home phenomenon may take pressure off capital cities. So there we have it, everyone. The five reasons for a cooling in the property market, according to Dr. Shane Oliver from AMP. What do you think, everyone? Some very reasonable points here. Nothing too shocking. In line with everything that we've been seeing happening. But, well, just check out this video with the Premier of New South Wales calling for 2 million more migrants, guys. That'll be an election issue. I think that will be an election issue. At least if more people are aware of the impact that's going to have on housing, it should be. Take care, guys. I'll see you next time.